And that sound means we are now live here on our YouTube channel. It is Monday night, and this is a special event we have planned for you. I'm your host, Coach Tim Justice, and welcome out to the show here tonight. Swing Trading 101, as taught by Coach Matt Justice. Matt is my brother. He's the CEO of Tackle Trading. He is a wonderful technician. He's been in the market since I've been in the market since 2005. He's built systems, he's run education companies, and he is your fearless leader of hashtag Team Tackle out there. And tonight we are going to cover what is swing trading in this show here today. Got a lot of people coming on into the chat. Before we get into the content, a couple things I want us to do here tonight. Number one, rules. Simple. Have fun, no negativity, communicate. I'm going to be monitoring the chat all day. If you guys got questions as we're going through the show, I'll handle them the best we can. And by the way, all my veterans out there, let's start this show right. Hashtag Team Tackle right in that chat. As always, let's keep that really, really positive and high energy over here tonight. A couple things that we're also going to do before we get started. Number one, if you are brand new to our channel, we do this kind of content quite regularly. We have a daily show called the Halftime Report every day where we go through the news and the market action. 12:30 Eastern, you should come and join us. And if you are a trader, an investor, and you love education, hit that subscribe button, hit that bell, and so that whenever we do go live, you get the alert. And by the way, out there, if you're watching this show, Tackle Trading is the premier online community for traders to learn together, to grow together, to reach our goals together, to communicate together, and to handle markets as they are moving back and forth and up and down and different opportunities. There's a link to our 15-day pro trial in the description of this video, and there's in the description of every one of our videos here at Tackle Trading. Come and join our pro membership, be a part of it. I know that you're going to love it and you will not regret that. Without further ado, though, let's bring in our presenter here for today, Coach Matt Justice. I know you got a big thing planned. Matt, Swing Trading 101. It's, a very important topic. What is swing trading?
That's a fascinating question, Tim. And there's not a specific definition. There is some subjective nature to it. In fact, I've told this story before, but I'll tell it a very quick version. One of the most compelling and fascinating arguments I've ever gotten to, not even an argument, more like a debate, was about 12 years ago when I was overseeing the first trading system that I was part of. And we had 10 cutthroat traders in there. It took us a long time to develop those systems. And we had some very, very difficult conversations in those moments as well. And one of them was literally the definition of a swing trade. And we sat down for this is 12 years ago, so it's kind of like an old fish story at this point, but it feels like we sat down for like 14 straight days just yelling at one another, trying to figure out what the specific definition of swing trading was. You have these philosophies out there, says anything more than a day, less than 2 weeks, that's a swing trade. But in general, quite frankly, whenever I've looked at swing trading, I've never tried to attach a specific time frame to swing trading. I feel like swing trading's best definition is left subjective to the individual stock itself, because individual stocks have cycles, individual stocks have personalities. Some stocks are volatile, some stocks are less volatile. Some stocks are very consistent and are, to a certain extent, a little bit of a slow burn where they go up and up and up and up and up for, seemingly 2.5 months before they do some type of deeper, bullish retracement. Other stocks go up 3, 4, 5 days. And so in general, when I categorize what swing trading is, I always think about it from a pivot to pivot type relationship. And so swing trading to me is you're targeting specific things. I'm buying at 180, I'm targeting 190. You don't really do that in any other style of trading outside of day trading when you're specifically targeting a certain number. For example, in position trading, for example, we're not exactly targeting something. We're adjusting stop losses over time. We're doing risk adverse option strategies. But in swing trading, you're specifically looking at buying at a certain level and selling at a certain level, and you plan that trade as you go into it. And so when I think about swing trading, I think about swing trading in the sense that swing trading is speculation. It is highly technical. You are looking to simply capture short-term price movement between two pivots, and we'll get into the definition of what a pivot is here in just a moment or so. But when you're looking at swing trading, you're literally pivot to pivot, typically speaking, and I'm just going to give you some typical numbers, you got to be more than a day, because anything less than a day is technically categorized as a day trade. And so when you're looking at swing trading, you're more than 2 days, typically less than 2 weeks, you're looking at capturing specific price movements from support to resistance or from resistance to support. You're highly technical, but in general, I've simply came to the subjective definition that swing trading is pivot to pivot. Again, it is unique to the actual personality of the stock. Now, when it comes to swing trading, honestly speaking, to understand this a little bit more clearly, we need to talk about the different types of traders out there. Now, for those of you that are new to the world of trading, this is going to be some fairly basic information. I'm going to cover multiple different concepts, multiple different times tonight. Going to talk about support, going to talk about trends, going to talk about patterns, going to talk a little bit about candlestick analysis. But in general, we're going to focus on the basics, the underlying philosophy of what swing trading is. Now, for those of you who are the proverbial hashtag team tackle, I'm certain you've heard this from me a few times before. So sit back, enjoy, participate, ask questions. Tim's going to be monitoring the chat here today as I focus on the presentation. And so if you are hashtag team tackle, or if you've just found tackle trading and you got a lot of experience as a trader and you're just getting maybe as a how do we go about swing trading or trying to catch a little tidbits, fantastic. Welcome to tackle trading. Appreciate you being here. But this is really for the basic, the beginners, the entry level, hence the word swing trading 101, kind of that starting point. And so I do feel it's fairly important as you're learning about swing trades to understand the different time frames when it comes to a swing trader. And so when it comes to the different time frames, you're looking at 4 categorization of traders. You have your day traders, which they work in every market. I put Forex and futures here because those are 24-hour markets. You don't have to worry about gapping situations nearly as much. But again, day traders are simply trying to capture what is known as intraday price action. And if you want to learn a little bit about intraday price action, check out Tech 101. Obviously, check out the STEP system. But every day in the halftime show, I literally talk about intraday price action. In fact, with the sell-off here today, I felt like I spent 45 minutes literally just detailing intraday price actions, because that's what day traders really kind of focus on, is what's happening within the 24-hour time period. And day trading is very important in the sense that it gives you a little bit of an indication of that shortest time frame, and that shortest time frame from a momentum perspective certainly can have a fairly big impact on those swing traders from a multiple time frame perspective. We talked about those swing traders being pivot to pivot. Position traders are a little bit longer term. Again, a lot of position traders think think about the old turtle traders, Richard Dennis, trend traders. Those are the original position traders, where literally they're simply trying to capture entire trends instead of specific movements behind the trend. And then you have your longer term trader, which is the investor, where they're trying to capture entire business cycles. They're looking to invest forever. Not really going to talk about the investor here today. And so when you look at it from a price action perspective, the swing trader is simply trying to capture what is known as pivot of support, pivot of resistance, a pivot to the next pivot. And so simply put, we're trying to catch what is known as a wave. This is a motive wave up, corrective wave down. You'll hear that at Tackle quite a bit. We're trying to ride the wave, catch the wave. Gina loves catching the wave. Well, in this sense, we're trying to capture the motive wave, or the difference between the price action between your support pivot and your resistance pivot. Now, the position trader, like I just indicated, they're not trying to capture just one specific price movement within a trend. They basically say, as long as the trend stays intact, as long as we have a higher high, higher low, higher high, higher low, they're going to stay in the trend, because once again, position trader, trend trader, very similar from a time frame and philosophical viewpoint. They're simply trying to capture entire trends. And so what they will do over time, and they like weekly charts as well as couple it with daily charts. We'll get into that here in just a little bit. but they're not looking to capture pivot to pivot. They're looking to capture the entire cycle of a trend. And that could be 3 months, could be 6 months, could be 12 months. It just really depends on the market and how long the market wants to stay consistent. And so when you're looking at swing trading, and again, specifically swing trading, we really have 3 philosophies when it comes to price action. And it's all about price, because it's not about what I think up here. It's certainly not what I feel down here. I have a lot of feelings. I live in my feelings, Tim, I do. But it's not what I think, and it's not what I feel. It's about my visual identification. My head, I'll overanalyze everything. I'll go detail this, what about this, what about A, B, C, D, E, F, G. I'll do that. That's my head. I microanalyze things, and it drives me absolutely crazy. I hate it about myself, but I don't know how not to do that. It's just the way my brain functions. But when it comes to my heart, I want so many positive things in life. I hope everybody has an absolutely fantastic day, fantastic week. I hope the market recovers for everybody tomorrow. All of that. We tell ourselves all the beautiful things about ourselves and some of the nasty things about ourselves all the time. Our heart lies to us constantly. What doesn't lie, what tells constant truth, is price action, and that's all about the visual identification. And so swing trading is really about your visual identification, what you're specifically reading on that chart. And so when it comes to the 3 pillars of swing trading, here's what we believe in. Write them down. Number 1, price is king. Price is, because we're going to do Queen's Court tomorrow, I got to say this: price is queen. Price is the jester. Price is everything. Price is king, queen, country. It is absolutely everything. It is the only thing we really rely on as short-term traders, is having that underlying philosophy of price matters more than anything else. The history of price is the barometer of the future of price. And so price is king. Number 2, price moves in cycles and trends. Price moves in cycles and trends. And if you can understand the pattern, the cycle, the trend, you can follow the trend, follow the pattern, because we believe price moves in cycles and trends. And then number 3, history. We know this about history. History has a tendency to repeat itself. It might not go 100% identical, but there is certainly an ebb and flow to the history of price action. Now, when it comes, let's go back really quickly here. When it comes to swing trading, and the focus really on tonight is about the basics. And there are 3 basics to swing trading. And these are going to be the focus point of what we're going to cover here tonight. Number 1 is understanding trend analysis. Looking at the trend, identifying the direction you want to trade. We say this all the time at Tackle. Your money, my money, all of our money collectively doesn't really move the marketplace. Institutional money moves the market. Hedge fund money moves the market. Traders move the market. Your mom and your pa who parks money in a 401k, they don't move the market. They have an impact long-term in the marketplace. They don't have an impact short-term in the market, because the only thing that drives price action is orders that are coming in and out of the market from a buy and a sell perspective on a daily basis. And quite frankly, my mom and dad, they don't do that. They park money in Coca-Cola. They look at General Motors. They look at their favorite XYZ stock. If it's my mom, and those of you who have around Tackle Trading for a while, she'll be like, Bitcoin, where's my Bitcoin? I want my Bitcoin. She calls Tim all the time. Where's my Bitcoin, Tim? And Tim's like, that's not how it works. That's what he eventually just gets to. Mom, that's not how it works. Because those individuals who are the long-term investors, they really don't drive markets on a daily basis. Once again, it's those big dogs, it's the active traders. And so we want to understand and identify the trend to know the direction we want to trade. And we'll get into trends here in just 1 second. Remember, these are the 3 major concepts we're going to repeat here tonight: is trends, patterns, and then the identification of what is known as support and resistance. Now, patterns Patterns have a tendency to repeat themselves. It's called pattern recognition is what it's called. We identify the pattern, we identify the repeating pattern, then we trade that pattern until that pattern stops. For example, when you're looking at the higher high, higher low scenario, let me get a drawing tool very quickly here. When you're looking at the higher low, higher high scenario, or your waves that go up, there's specific patterns that happen in what is known as a trend. And we'll get into that here in just a moment, but we call it the 1, 2, 3 pattern: breakouts, overextended, pullbacks, or retracements. And again, we'll go into that into quite some detail here in just one moment. And so we identify the trend to know the pure direction we want to trade. We identify the pattern to identify the repeating pattern. And then we identify the concept of support and resistance to ensure that we understand exactly when we want to make the trade versus when we want to get out. Because remember, at the definitional level of swing trading, it is simply pivot to pivot. We're trying to catch or ride the wave. We're looking to buy at support, sell at resistance. Buy at support, sell at resistance. Rinse, repeat until it doesn't work. And the longer you go as a trader, obviously it's not going to work every now and then. That's not what trading is about. Swing trading is not about going out there and making 5 trades this year and hitting 4 out of your 5 trades. That is not what swing trading is about. Swing trading is about identifying trends, patterns, and making trades. And the more trades you work, the better the probability works for you as well. And so these are the 3 major concepts we want to focus on here tonight. Now, when it comes to the concept of a trend, when it looks at a trend, you have 3 types of trends. The first type of trend that you have is what is called a bullish uptrend. Once again, it is called a bullish uptrend. And when you look at a bullish uptrend, what you really kind of have is you have this cycle that occurs. Now, there was an old trader by the name of Wyckoff. And how many of you have ever heard of the Wyckoff market cycle, the Wyckoff price cycle? It's basically, and this is a guy who lived 100 years ago, great famous trader, started identifying trends and patterns, same type of thing with Elliott wave and Fibonacci. All of these things were originally done before we ever even had computers. But what these old time traders did was they would identify certain behavioral characteristics. And again, behavioral analysis is a very near and dear to my heart, as anybody who can watch the halftime report can attest. But at the end of the day, that's what these old traders would do. They would look at the behavioral analysis behind patterns in the marketplace back in the late 20th century, late 19th century, early 20th century, and they would draw these patterns on literally graph paper and identify the behavioral analysis that would kind of drive the overall market cycle. And so Wyckoff developed a price action market theory, which is honestly, quite frankly, still a leading principle in today's trading. The Wyckoff method basically states that the price cycle of a traded instrument goes in what is known as 4 stages. And I want you guys to write down these stages. Again, we'll give them other terms for them just based on what we do at Tackle, or typical language you will hear in the marketplace. But at the end of the day, you're looking at accumulation, markup, distribution, and what is known as markdown. And so according to the Wyckoff market cycle, or price cycle, as you have seen many times in trends, you basically have a series of cycles that occur in the marketplace. As the market comes into what is known as the oversold zone, what you will start to see is accumulation. And basically, as the market's coming down, 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 the market's going to get into a price where it attracts more buyers than sellers. And so as the market goes up and up and up and up, the higher the price, the more sellers that are going to be attracted there, because we want to make more money. It's very simple, guys. Markets go up. Yeah, I want to sell a little bit. I want to lock in some of that gain. Market goes down. I might want to repeat the process and get a nice little value company at what I feel is a really good price. And so as the market's coming down, 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 down in a trend, we call that profit taking sessions. Well, what is actually happening is the distribution of the money that has already been made. And so as you start coming down, it's based on distribution or increasing supply. As that gets to the low price, what will happen is you'll start to see the market form what is known as a U shape, V shape, or slowing momentum as the accumulation starts to offset the distribution. And that has a tendency to drive the markets back up, 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 known as the markup. And so now as the market gets a little bit overextended, you start to see the overbought scenario. Well, when things get overbought, we're not getting a good price any longer, guys. We gotta wait. We gotta wait for the market to come back down. We gotta wait for the technicals to reset. We gotta be a little bit patient here. And you'll hear us say this at Tackle all the time. Patience is a position. It really is. Waiting and being patient for that specific setup does take a certain amount of skill set. And so as it gets a little overextended, it comes down, gets oversold, and we just see that rinse and repeat that creates that trend. And what happens, you have a nice little price accumulation, price appreciation, nice little bullish environment. But in that nice little bullish environment over the course of a year, 5 years, 10 years, 100 years, I honestly don't care what time frame you put this on. It works consistently on all time frames. But over the course of that long time frame, you have this series of waves that occur within that primary trend. And we're simply trying to attach ourselves to the pattern that is happening within that overall trend. And so that's what you're really looking at in a price trend, is you're looking at this accumulation distribution over time. And it's what it's really based on is behavioral analysis. That's one of the reasons why technical analysis is king, queen, and country, and why we believe in it is it's consistent over time. And so that's what you're looking at in a bullish uptrend. And so when we come to the market, I'll go live here in a second, but I want to talk about bearish downtrends, and then we'll go in and do a little trend analysis very quickly. Now, in a bearish downtrend, so basically in that bullish uptrend, as the distribution accumulation happens, it happens more with accumulation over time. That's the demand. Demand is constantly outpacing supply. But when you're talking about a bearish downtrend and markets are coming down over time, what you see is the opposite occur. You see the same cycle. It's just downward over time because, once again, fear is driving, supply is driving, the overbought conditions are getting sold fairly aggressively. And so you can see these cycles occur over time, and you're simply trying to attach yourself to the trend and the pattern. And so when it comes to the Wyckoff price cycle from a downtrending environment, you're looking at the exact same thing. The only difference is it's now 45-degree angle down, primary downtrend, and the accumulation distribution happens in a downtrend. But really what it is it is the exact same thing. Price gets oversold. What do traders do? Well, they're going to lock in profit. What type of profit are they locking in? They're not locking in the loss that they bought. Sure, that's happening too. But what they're really doing is they're locking in their shorts. They've been shorting as it's going down. They have to buy it back. It drives it back up. And this price cycle simply repeats itself over and over and over until it doesn't. And we are not the traders that are going to try to pick the end of a trend. No. That's not us. We don't need to be Nostradamus. We don't have to be the seer. We don't have to have the almanac from Back to the Future, folks. That's not us. That's not what we have to do. What we have to do is be able to read the behavioral analysis of what creates the technical trend in the first place. That's our underlying belief, is the technical analysis. And so when the trends are over, it's not about me wanting it or feeling it. It's about the visual identification of what we actually see on that chart. And so what I want to do now, guys, is I want to go into TOS, and I want to look at a couple different things very quickly, just from a trending perspective. And I'm going to draw some stuff. Now, we talked about this from a overall Wyckoff market cycle perspective. What I want to do very quickly is I want to just talk about this from a trending perspective, just from a whiteboard, or obviously here we're looking at a blackboard. So when you're looking at a trend, and let me get my nice little drawing tool, every trend starts with something. And again, guys, I'm an educator at heart. And what I believe as an educator perspective is it's not just about hearing something one time before you really understand it. You got to hear things over and over and over. And when I mean you, I mean me, Tim, Mark, Cody, Emily, all of us do. We need to hear things over time. And so there's going to be a certain amount of redundancy here as I introduce certain topics to people. Now, when it comes to a trend has to start with something. Whatever the previous trend was, whatever it was, that doesn't matter to me. A trend fundamentally has to start with something, because the first identification of a higher high has to violate something in the past, which means a trend starts with what is known as a breakout. And I want everybody to type that into the YouTube chat, breakout. That's where the trend begins. And so when it comes to a trend, let's say we got a nice, oh man, that's a big price action there, Tim. Look at that. That is a little too big. Let's go there. Okay. Now, what we look at is we look at the beginnings of a trend, and it will look a lot like this, just random price action. Now, a trend begins when you get what is known as a breakout. That's when a trend begins. And so when I'm looking at a trend, and this trend is neutral, and it's neutral over a month or 2 months or 3 months, and what neutrality means is there's no clear identification of pivot relationship. And so as you can see, that's a higher low versus that one, but then that's a lower low against that one. And so you have mixed trends happening. And again, honestly speaking, I'll come back to lore here in a second, but just go look at the Russell 2000 if you want a good picture of what neutrality looks like over time. But that's what you're going to see. You're going to see a series of up and down, up and down, up and down, just creating what is called a neutral condition. Now, neutral conditions are not bad for traders. Neutral conditions can be amazing. Go ask Coach M. Go ask Coach Tyler. Go ask Coach Tim. Go ask Coach Gino. Go ask those cash flow traders of tackle trading how much they love cash flow systems when they're compounding, covered calls, naked puts, credit spreads. They can be very good trading environments, but only for the type of trader that knows how to cash flow. When it comes to a swing trader, we're not looking at that. When it comes to a swing trader, we're trying to capture price movements. We're trying to hit and quite frankly, guys, we're trying to hit home runs. We're trying to take a scenario and just hit a home run. We're not looking for base hits here. I can go sell covered call for base hits. Go find me any naked put Mark's been selling over the last 6 months, and you can get you a nice little base hit constantly over time, every time, right? What we're trying to do in swing trading is we're trying to hit a double. I'm gonna choke up on the bat. I'm gonna smack that down the right field line. I'm gonna try to hit a double. I'm gonna try to drill that right center fielder. I'm gonna try to slap it down the left field line. I am targeting a specific thing. And so when it comes to trading, once again, the trend is very important when you identify the beginning point. And the beginning point is when you see that breakout. And so when you see the breakout, that is step one. And that can certainly be traded right here. You got the breakout. Now you get the breakout. You break out of the previous level resistance. You see the price appreciation up, 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 up. Now, who's making money here, folks? Who's making money here? It's the buyers. It's the individuals who bought the stock, bought call options, right? It's the buyers. Now, price doesn't just go up, right? Price goes up and down and up and down, and it has this nice little rhythm to it over time because of the Wyckoff cycle we talked about. So what starts to occur at the top? Well, distribution starts to occur. Increasing supply starts to occur because, again, the price traders were getting a week ago, you're no longer getting. And you don't see that price at 36, as you can see over here. You don't see that as the same value as you did on the breakout of 32. But psychologically, something else happens here, ladies and gentlemen. The trained assassins out there, the traders out there, the technicians out there, they are not going to chase this price. Not going to happen. They're not going to chase price. They're going to wait for price to come back because they know the cycle. They're patient. They're waiting. They're waiting for their opportunity to pounce to a certain extent. And so as the market gets overexcited and gets overheated in the short term, you start to see traders lock in profit. The distribution starts occurring. And what occurs is the market starts to come back down and form what is known as a higher level of support. And it is at this point where the accumulation starts happening again. And what you have, therefore, is a trending environment that we rinse and we repeat until it doesn't work. So, for example, I said this earlier, we're not the traders that are going to say this trend is too consistent. We're not the traders that are going to say it's been too good for too long. That's not us. We aren't those traders. We're the traders that are going to be consistent with price action and follow our rules over time. And so when I said earlier, you don't have to think about when this ends. See, as a new trader, you're going to be wanting to be right. And I get it. I still, guys, I've been doing it 17 years. I still want to be right. Totally understand, totally respect it. I want to hit a high batting average. I want to be right. I don't want to be proven wrong. I don't want the market to fake me out. I'm the same way as everybody else here, but my philosophy over time is it's never about one trade, because I know trading is not about one trade. It's about trading over time. And I said, you never have to get to the point where you're like, oh, when is this trend going to stop? I don't know. Guys, I can't tell you how many times I get asked that question. Oh, how long is this market going to be bullish? I don't know. I adjust rankings every week. I don't know. Oh, when's the market going to go down? I don't know. I have no clue. Tomorrow? I don't know. We had a lot of volatility today. Might go down again tomorrow, right? We don't know. We're not those traders. Again, we don't think, we don't feel, we visually identify. And so when you see the characteristics, because trends over time work like the Wyckoff cycle over time as well. In a one singular cycle, yes, you see this as elevated. Even though you're still going to be willing to pay 46 on the next retracement, you still see it as elevated. So over time, you'll see the trend that way as well. But once again, what happens in technical analysis is things start changing. And that's what we call pattern recognition. Patterns are consistent until they change. And when they change, we have to adapt with it. I say this all the time, guys. Come to the halftime report, literally come to the halftime report. I do this every day in the halftime report, and I talk about the shifting characteristics of trends. I talk about shifting volatility at the top of trends. There are certain identifications you will see at the top of the trends that can be wonderful indicators to help you identify when these trends are starting to fail. But at the end of the day, all you have to do is wait for the visual identification of resistance to hold, and thus you no longer have a higher high. The trend is over. And so that's the overall concept when you're looking at what is known as a bullish trend to a certain extent. Now, when we're looking at it from a bearish downtrend perspective, you see something fairly similar. Let me get my drawing tool here. That's right, Tackle. I got drawing tools. It's not just Gino anymore. Now, when you're looking at it, again, random pivots define neutrality, ladies and gentlemen. Random pivots define neutrality. Now, if a breakout starts a bullish uptrend and thus triggers us to start trading the cycle, well, what starts a bearish downtrend and thus starts our desire to start shorting stock? Well, what starts that is what is known as a bearish breakdown. And so you identify support, we'll call it $50 right here. Once support is violated, that starts the bearish downtrend, and then it's simply walking down the stairs. Lower low, lower high, lower low, lower high. And thus you see that accumulation distribution, but over time, it simply creates lower levels of support and lower levels of resistance. So once again, when it comes to the trending perspective of the market, we're simply trying to identify the higher high and the higher low when it comes to a bullish uptrend, and a lower low, lower high when it comes to a bearish downtrend. Now, that's from a trend perspective. Let's talk patterns. How many patterns are there in the market? You guys, just take a guess. How many patterns? By the way, I don't know the answer. Patterns, Tim makes up a pattern every Tuesday. We literally in Queen's Court, Tim will make up patterns. I love it. It's fantastic. By the way, I don't say that with judgment. I make up patterns too. We see things all the time. We visually identify new things all the time. So there's not really one set. And by the way, when I teach people technical analysis, yeah, I start with specific patterns in the market that do manifest themselves over time. But remember, it doesn't start with identify pattern. It starts with identify trend. That's what it starts with, identify trend. The pattern is being able to read the analysis in the real time. So when it comes to pattern recognition, patterns are deeply rooted in our DNA, ladies and gentlemen, deeply rooted in our DNA. From the time we are born to the time we leave this amazing earth, we identify patterns. They manifest themselves in our everyday life. They manifest themselves in literally our DNA. Literally our DNA has pattern recognition in it. And one of the things that I did when my kids were young is I would give them, and you guys at Team Tackle, you guys know how I like to get down. I like to give analogies and tell stories when I'm trying to teach a specific concept. Well, one time, and I've told this story before, but I'll tell it again here. One time, I was up with my 8-year-old daughter. She is currently 12, and she's 12 going on like 38 right now. Somebody tell me how that works. But she was 8 years old at the time, and we were in Utah, up in Salt Lake City, Utah, and we were up in Park City. And if you guys have ever been up to Park City, oh man, get to Utah, get to Park City, just beautiful, beautiful country up there. And it's one of those areas where you're 10,000 feet in the air. There's no smog, no pollution, and very little people. It's quiet, it's beautiful, it's amazing. And you know what? Unlike when I'm sitting down in Salt Lake City, and you look up at the nighttime sky and you can't really see much, man, you can go up to Park City, you're above all the nonsense, you're above all the fray, and you can see a billion stars in that nighttime sky. And it is just so beautiful. And what I was doing is we were looking up at the stars on the back of my truck, me and my 8-year-old. And I'm pointing up at the sky, all these different stars, and I'm trying to identify patterns with her. And I'm sure you parents have done the exact same thing I'm talking about with your children. And I'm identifying the patterns, and I'm trying to teach my daughter how to identify the Big Dipper. And I swear to heaven, guys, there's a billion stars up there. It was the most beautiful nighttime sky. There was no moon up. It was just a gorgeous, gorgeous, gorgeous thing. And we're looking up at the nighttime sky, and she can't see it. There's nothing. She can't see. All she sees is a billion stars. She has not yet trained her eye on what specifically to look at. And so at that point, I said, yeah, it's kind of hard to see, right? You see all this, just a billion stars. And for those of you that can identify the Big Dipper, and I know there's many of you, it's just 7 stars. Got a little pan, got a little hook. And I look up there and I point up and I say, look at that star right there. Do you see that star right there? She says, yeah, I see that star. It's a little shiny. I'm like, all right, follow it down. Now identify that little handle. Identify that nice little Big Dipper. And you should have saw the eyes pop out of her head and the excitement in her voice, and just her little breath just got a little shallow, and it was the cutest thing. She's like, oh, dad, 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 dad. I'm like, yeah, I know, it's pattern recognition. Wait till you can do it on a chart, because it's the same thing, guys. When you look at a trend, when you look at a pattern, when you look at just a price chart, so many times you're taking in so much data. You're taking in so much information that it is extremely hard to process, because you haven't yet trained your eye on where to find those 7 stars or those 7 candles or those 7 points of data or that slowing momentum candle at the Fibonacci 38% retracement. You haven't done it yet. It's not that it's difficult, guys. It's not. I promise you it's not. Just like my daughter can identify the Big Dipper at 8, I promise you she can identify a higher high, higher low at 8 as well. And so when you're looking at it from a pattern perspective, once you identify the pattern, once you have trained your eye on the pattern, you simply identify it and you trade it over time. And it is not difficult. It's not. The first time you identify a constellation might take some time. The second time, like that. The first time you learn how to identify the characteristics of a bullish retracement, a bullish pendant, or a bullish flag, and the subtle differences between the 3, yeah, that might take time at first, but as you indoctrinate yourself, as you ingrain yourself, as you start understanding it more, all of a sudden, it's like clockwork, over and over and over again. And so when it comes to pattern recognition, there are 1,010,000 different types of patterns. You have candlestick patterns, and no, I'm not going to detail candlestick analysis today, but just to understand, you have candlestick patterns, you have technical price action patterns such as reversals. Reversals are like M formation, W formations, head and shoulder formations, inverted head and shoulder formations. By the way, post-pandemic, no joke, guys. Post-pandemic, my favorite reversal is not a head and shoulders, is not a nice little W formation, although I do geek out on a nice W formation. Love those W's. By the way, W stands for win, okay? Because we're all winners at heart, right? That's how it works, Tim? Yeah. So, but the 1, 2, 3 bullish reversal pattern, where it doesn't even reverse, it just starts V-shaped recovering. And so post-pandemic, guys, one of the, and I've done a lot of this, like what's different pre-pandemic, post-pandemic? Reversals. That's the number one key difference from a technical perspective for me, is the speed of the reversals. Not all the time do we get these methodical W formations over a 4-month time frame. Not very often right now do we get these 6-month head and shoulders where we like, oh man, that's just sexy, let's go. A lot of times we get what's known as a V-shaped recovery, where I just simply call it the 1, 2, 3 pattern, because all of a sudden it just starts trending. The signal, by the way, for you advanced traders, first high or low, right there, first high or low. But again, I digest. You look at the patterns, there are a tremendous amount of different patterns out there. Once again, breakout patterns, continuation patterns, ascending triangle patterns, high base, low base, cup and handle, inverted cup and handle, MWs, 1, 2, 3 patterns. Yeah, I mean, you name it. There are a ton of different patterns out there. But the beautiful thing about pattern recognition is once you learn one, the others are just a slight difference from the one in the first place, because all of this is based on, once again, accumulation, distribution, or otherwise known as supply or demand, or at the bare basis level, let's just call them teams, the bear team and the bull team. Now, once again, in a trending condition though, you don't have 1,000,001. That's why we love trading in trending conditions, ladies and gentlemen. Once again, most of these patterns that I just detailed Those are end of trends, continuation, which is a subtle end of a trend, but these are all advanced trending or end of trend type patterns. And again, the difference between a flag and a retracement, or excuse me, the difference between a high base, a flag, or a retracement is honestly how many days and what percentage decline did it have against the higher high. It's subtle is my point. But when it comes to a trend, the reason why we traders, and again, the directional traders, people who love to swing trade, the reason we love trending condition is unlike the end of a trend where you have 1,000,001 patterns, unlike long range neutrality, which you have zero consistency pivot to pivot behaviors. In a trend, there are really only 3 basic patterns. And whereas 1,000,001 can be a little bit difficult, the same thing about the stars I talked to you guys about with my daughter. There's 1,000,000,000 stars. Once you just identify 7 little stars, you can identify everything you need to identify that specific pattern. And so let's come down basically to what we were talking about, and let's make this extremely simple. About 5 years ago, I was teaching a class, and I believe I was in Dallas, Texas. I believe I was in Dallas, Texas, because 5 years ago, I was always in Dallas, Texas. I love Texas so much. And I was I believe it was either San Antonio, Austin, Houston. I was somewhere in Texas. And I was asked a question on all of this. And it was I'd say 30, 35-year-old woman in the room. And we were sent down and we were talking technical analysis. And she was like, Matt, I'm just so overwhelmed by all of this. And by the way, guys, this was like 5 hours into a technical class. I was overwhelmed at that point. But I sat her down. I said, okay, let's really keep it simple. Write down the number 1. Just write down the number 1. Just a breakout. Whenever it breaks resistance, that's number 1. That's it. It's just number 1. We're not going to call it anything. You're just going to say 1. And you know what? What do you do when you see 1? She says, I buy. I said, you're right, you buy. So on 1, what do? We buy. You're right. Does it matter if it was a high base breakout? She says no. Does it matter if it was an ascending triangle breakout? She says no. Does it matter if it was a symmetrical triangle breakout? She did say no, and I said it doesn't matter. I don't like symmetrical triangles in the first place. But you get my point. She was getting confused with the simple categorization of things, not with the visual identification. We will make things very difficult on ourselves simply because we want to understand, even if we never will, we want to have the belief of understanding of something, of how it works. But that's not the importance. The importance is 1, I buy, because that's what works. And so I started teaching this from a 1, 2, 3 perspective. And I loved it. I absolutely loved it, because I do think the art I do believe the art of trading can be very difficult emotionally. It can be extremely difficult. Behavioral analysis in ourselves is as important as anything else. But the actual concepts of understanding what to trade and how to do it can be fairly simple. When you see a trending environment, you're simply looking at a higher high, higher low. That's all you're looking at it from a simplicity perspective. When you look at what we at Tackle Trading call the core 1, 2, 3 pattern, it takes into account the 3 major technical identifications that we have to understand from a trending perspective, because these are when we take action. Everything else is about the identification of something, what we want to trade, when we want to trade it, and how we want to trade it. But when it comes to the 1, 2, 3, these are specific actionable items. When it comes to the core 1, 2, 3 pattern, we've already talked about this, but it starts with the 1. And the 1 is a breakout. When you see resistance broken out of, that's what we call a breakout. A breakout is when we see the market achieve a higher level of resistance and thus establish that first trending environment. One is the breakout. Now, remember the Wyckoff cycle. It gets overextended, right? And so pattern number 2 is what we call the overextended scenario. And so when we're overextended in pattern number 2, the trading has been done. Like it's over, like done. We're not going to chase, guys. We don't chase dragons. That's not what we do. We're patient. If we miss the breakout, we're okay. We're okay. We missed out on that one opportunity out of a million and one opportunities that represents itself every day in the stock market. We're okay with that. We're not going to chase 2. We're not going to chase when all the other traders on Wall Street, all the other traders at Goldman Sachs, all the other traders at JP Morgan, we're not going to chase when Jamie Dimon has told his traders to sell, because those traders are trained assassins. They understand the Wyckoff cycle. They're not going to chase either. They're going to be patient the same way we are. We're not going to chase. We're going to distribute. We're going to lock in profit. We're going to sell the breakout, because once again, the price we paid in one, it was a fair price. We got it on the breakout. It's went up and up and up and up. Well, the only way to actually make money as a trader, ladies and gentlemen, is to do what? Is to sell, is to redistribute. Distribution coming back into the market, thus creates pattern number 3. And what pattern number 3 is it absolutely is that bullish retracement. And so when you're looking at this from a technical perspective, once again, we can get all caught up in higher highs, higher lows, and technical terms like Fibonacci's and Elliott waves like corrective waves and motive waves. But when it really comes down to it, those are just names, because somebody has to call something something. What do we like? We like 1 and 3. Make it simple. Breakouts, retracements. 1 we buy, 2 we sell, 3 we repeat. And we rinse and repeat until it changes. Once again, in the bearish downtrend, you have oversold, overbought conditions. Over time, these create lower lows, lower highs. At the overbought, we're going to distribute, and that's going to drive the markdown down into the oversold condition. Rinse and repeat. Now, once again, when it comes to the simplified pattern, the only thing you're looking at is what is known as a lower low, lower high, lower low, lower high, lower low, lower high. And so once again, you're looking at the pattern, lower low, lower high, lower low, lower high, accumulation, distribution, lower lows, lower highs, lower lows, lower highs. It doesn't matter. Lower lows or highs are what we like to call it. Now, when it comes to the 1, 2, 3 pattern on the downside, okay, and again, this is the beautiful thing about technical analysis, guys. It's universal. It's universal. It is universal. If you're looking at a stock, if you're looking at a commodity, if you're looking at a currency, the technical analysis behind them is universal. If you're looking at a day trade, if you're looking at a swing trade, if you're looking at a position trade, intraday analysis to daily analysis to weekly analysis, it's the same. Higher highs, higher lows, distribution, accumulation. The only thing that is different is the time frame you're looking at and matching the time frame to the type of trader. But at the end of the day, the 1, 2, 3 pattern is consistent regardless of the time frame. That's why I love it. And so when you're looking at the beginning of a downtrend, and again, trending environments are everything. Once again, price is king, queen, country. It is everything. That's in trend analysis. And so when the beginnings of a bearish downtrend happen, it happens with the violation of support. And again, I'm going to get into support and resistance here in just one moment. And so it starts with the visual identification of support violating, or support gets broken. Once support is broken, and I want you to think about support like this, guys. Let's say I'm in a hotel. and I'm on floor number 3. Okay. And I'm on floor number 3. And all of a sudden, floor number 3 ceases to exist, no longer exist. Where would I go? Just all of a sudden, it just ceased to exist. Where would I go? I don't need to put a gamble on it, guys. Don't need to wager a bet. I know what happens to gravity. I'm not Cody the scientist, but I do know how gravity works. I'm going to go down, and I'm going to go down to wherever that next level of support is. I'm going to go to floor 2. That's what's going to happen. It's guaranteed. Trading works very similar, guys. When support is violated and there is nothing else there, the market will go down to the next level of support. It's going to go find that next level of support. It will find whether that is a historically defined event or whether that is a random active occurrence. It will figure out where that next level of support is. Well, that's the one. That's the breakdown. We're walking down the stairs now. We don't need to get emotional to it. Markets go up, markets go down over time. They happen. Today was a bad day for the bulls. Lots stopped out. So it happens. Trends get violated. Support gets violated. Trading isn't about one trade. It's about trading over time. So when you're talking about that bearish breakdown, 1 violates, goes to 2. The shorting happens. See, this is something beautiful about bearish trends, guys. There are automatic scenarios that happen. See, guys, where we train, and when I mean we, I mean the collective we, the universal we, the Wall Street we, all the market participants we, the collective we is what I'm talking about. All market participants, whether you are trained in the S.T.E.P system or you're trained in the Goldman Sachs way of ripping people, I don't know. I don't care. It doesn't matter to me because we're all trained to play stop losses. And we're all trained to place stop losses under support. And so if the market breaks support and the dam does in fact break, what occurs is something natural, not unnatural. You already have stop losses there. If I want out now. I don't want to get out after the bloody move. No, I want out now. I got a stop loss. Market breaks support, stops are hit, price drives down. Well, once again, guys, ladies and gentlemen, once again, price doesn't just go down, because as the market is going down, down, down based on buyers dumping because they don't want anything and can't take the pain anymore, right? Or the traders shorting stock and borrowing everybody else's stock that doesn't want to sell, regardless of what the scenario is, at some point, those traders are going to lock in profit. At some point, and when I mean some point, I mean like 3 to 7 days on average. At some point, those traders are going to look at the opportunity as a buyer instead of a seller because we're no longer looking at distribution, but what are we looking at? Accumulation. A trend and a pattern and a cycle that has been very consistent for 100 years. In different market cycles, in market cycles that were algorithm driven in 2021, where 90% of the entire marketplace is not you and me in la la land clicking random buttons behind a screen somewhere, but in algorithms, automated tradings constantly over and over and over and over and over and over and over again. And yet it's still consistent. Even with algorithms, it's still consistent. When it was just ma and pa dumping or buying based on something that happened in 1955, it was still consistent. It's consistent because, once again, technical analysis is created. It is created based on certain behavioral analysis out of us human beings and certain responses we have to the almighty dollar and our emotional connection to the almighty dollar. And that goes based on prospect theory, guys. And so what happens is once that violates support and drives down, dump, 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 dump. Well, the accumulation starts to happen because of what? Number one, traders lock in profit. And for a trader to make money as a bear, yes, they do still exist, even though we like to make fun of them. They still do exist. But even as a bear, as the traders start going down, 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 they have to buy back the stock to get out of the trade. So all the stock they borrowed on one, where it violated support, hit all those stop losses, drove the market down, all of that, they're now going to see vastly different because now it is in the accumulation stage. It gets overextended into pattern number two. Pattern number two, and yes, guys, I am talking behavioral analysis with technicals because he understands what happens with the price movement. Price movement then drives back into pattern number three. All of a sudden, now the viewpoint changes. We're not looking at a low price overextended. We're looking at a retracement coming back up into resistance. Well, the traders that didn't hit one, or the traders that did, they're going to re-up for three. And so in pattern number one, the bearish breakdown, technically, the terminology is bearish breakdown. The pattern number one drives markets down into pattern number two. Pattern number two is the overextended situation. Accumulation starts occur, drives the market back up into pattern number three, thus creating that lower low, lower high, lower low, lower high. And once again, do I care if this trend lasts 3 months, 6 months, 12 months? Do I care if it goes from Amazon at 3,500 to GameStop at 100 to GoPro at whatever that dirty company is at this point, $10, whatever it is? I don't care. I'm never going to second guess the trend. I'm never going to second guess the pattern. I'm never going to second guess anything from a technical perspective because it is based on 6 billion transactions on a daily basis. I am not going to interview every single person, every single trader, every single algorithm to figure out the psychological nature of what caused them to buy or sell or dump or hold or whatever it is, because quite frankly, I don't care. What I do care about is what I do on this trend. And in pattern number one, I am trained to short. In pattern number two, I am trained to close the trade. And in pattern number three, I am trained to reassess the situation and wait for that drive back down in price and for us just to get the big stick and go hit a really big home run, guys. We're trained. None of us were born as traders. That's not how it works, even though trading is the second oldest profession in the history of mankind. We are trained. We are created the same way you guys are. The same, we're no different than everybody else. I just sat somewhere, someplace 17 years ago and saw an opportunity and said yes. That's the only difference. There's a lot of ways to make money in this market, guys. But from a technical perspective, many technical systems are programmed based on the exact same philosophy. It's not exactly like it's unique, that it's proprietary to any one system or any one individual or any one company. Goldman Sachs, JP Morgan tackle trading. Yes, they're the devil, we're amazing. That's not the point. The point is we're all trained in the similar techniques and tactics. It's a repeating process that repeats over time because of what traders are programmed to behave and act like over time. Technical analysis works, quite frankly, because people use it. That's why it works. That's why it's consistent. That doesn't mean it works every time. That's not how probability works. Probability works over time, not every time. And so in the Wyckoff cycle, from a simplicity perspective, we're looking at lower low, lower high. From a tradable action perspective, it's the 1, 2, 3 pattern. In the bullish environment, we're looking at 1, breakout, 2, overextended, 3, retracement. The trade is on 1, the breakout. We like to lock in profit on 2, the overextended scenario, 3, snapback retracement comes into support. That's our next topic. We trade again. Programmed, trained. In the bearish cycle, once again, the pattern simplified. Lower low, lower high, lower low, lower high. Looking at it from a 1, 2, 3 perspective, all trends start with neutrality. Neutrality gets blasted based on a breakout. Breakdown, breakout. Breakout is up, breakdown is down. Pattern number one is the breakdown. That's where we're looking to short, buy put options, trade bearish strategies. Pattern number two gets overextended. The accumulation starts to happen. Demand picks up. Pattern number three, we're looking at the pivot down. Trade the pattern, trade the trend. Now, from a technical perspective, how do I say this? I love analyzing trends, love analyzing patterns, love analyzing support and resistance. I believe they're all extremely needed when it comes to the identification of being a successful swing trader. But if there's one concept that I feel has changed a little bit post-pandemic, guys, and I say post-pandemic because how I personally categorize the marketplace is before March, after March type scenarios. The pandemic did change certain things from a swing trader's perspective. One of the things that it did change for me, and I think this will get back to being consistent over time. I do. Things have a tendency to revert to the mean over time. But for right now, I think if there's two things that have changed technically for me post-pandemic is reversals, like I indicated. Before the pandemic on a reversal, man, it was W's, it was head and shoulder formations, or it was nothing. Like V-shaped recoveries, I'm out, done, hate them, drives me crazy. Kind of same philosophy as symmetrical triangles. They just take on a personality of themselves. And I just can't stand the exploding volatility one way or the other scenarios. I like consistency in price action. I'm not saying I like I like to trade companies like Verizon. No, I love trading companies like Netflix. I just love consistency in price action. It can have an ATR that averages 3% daily. I could care less about that. I'm an old recovering Forex trader. I don't care about the volatility. What I care about is the consistency of price action. So the two things I would say changed technically for me, and lots have changed, but two things high level perspective were the speed of reversals. The 1, 2, 3 reversal is much more common today than it was pre-pandemic. And I would say the concept of support, and resistance has always chiefly been vitally important. I would say it was number one before pandemic. It was number one after pandemic. But the value I put on the identification of support is even more important today than it ever has been. And you'll hear me talk about in the halftime show, for example, I talk a lot about you got to like this zone, right? You got to like this zone that it's in. And that zone has a lot to do with the identification of those support levels that we're looking at. Because of the volatility, post-pandemic can be fairly random. I like zones around support levels, especially where you can see the combination of different support techniques kind of all aligning simultaneously together. So we'll talk about that here in just 1 second. But when it comes to the identification of support and resistance, they are known what is a pivot. And so you heard me say at the very beginning of this webinar, guys, and I truly do hope everybody's learning something, whether you're here finding us for the first time and you're just trying to hone in your skill set, or you're learning something, you're interested in learning a new topic and you're interested in learning trading, or you're the old amazing veteran of tackle trading and you've heard me talk about geek out on support and resistance a million times before. I just truly do hope all of you guys have enjoyed this webinar, that you all learned something from this webinar. Because what are we doing if we're not learning, right? What are we doing here if we're not trying to improve, trying to learn? And so I do hope I have been a good educator for you guys here tonight. But I want to talk a little bit about support and resistance. Support is always defined by the marketplace. Resistance is always defined by the marketplace. It doesn't mean we can't prepare for where those levels will form. And that's a very important form of analysis in and of itself, and it's called what is known as a technical catalyst. A technical catalyst is a technique that you utilize to identify where support could form. But in the back of your mind, you know it's just a hypothetical catalyst and not something that is a guarantee, right? We just want to be prepared. That old Boy Scout motto, I want to be prepared for where pattern number 3 is going to form, where pattern number 2 is going to form, where pattern number 1 is going to form, at least in the best capacity I can be prepared. Because once again, today is one of those days where the random acts of violence in the market does occur. And what I mean by that is the random volatility, where it just moves inconsistent. That does certainly transpire. Now, when you're talking about support and resistance, support is the floor. Remember, we're walking up the stairs. We're walking up the stairs. Every time you take a step up, you got a higher level of support. Support is that floor that stops you from going lower. It's your chair. It's my floor. It's a table. If I got my desk right here, and I got some chapstick. My wife makes amazing chapstick. And if I drop this chapstick, I guarantee it's going to go somewhere. It went to my desk, and I can guarantee that because my desk is a catalyst. It's not a guarantee. It's not. There are scenarios where that chapstick falls through that desk and they start with me, breaking a hole in my desk, and it goes to the floor, which would be the next level of support. Support is defined by the market. Support was not support on my desk until this chapstick, and again, I'm just using this as an example because it's the first thing I picked up. This chapstick right here was a catalyst that created the desk as support, but it was not support until this tested it. Everything is hypothetical until it's tested. And you'll hear that at Tackle a lot. It's going through a test. Test can be volatile. Let's wait to see if it passed the test. That's because you're bouncing off support. You're bouncing off support. You want to see support build and thus confirm. Now, what support is, it is the area on the chart where you see the pivot formation. It is the higher low. It is the level of support that shows an increase. When you're looking at support, what it technically is when supply is outpaced by demand, or when the accumulation phase in the Wyckoff cycle starts to occur and it offsets the supply or the distribution. And so as the market is coming down, 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 it gets to a price level where the value of that in the short term outweighs the concern, and you start to see demand pick up and thus carry the market higher and higher and higher. Everything is a hypothetical until it is confirmed. Once again, I can prepare for where those levels will form. This is what is known as a technical catalyst. But at the end of the day, it is just a catalyst until that catalyst has been tested and thus passed the test by watching with your visual identification. Once again, man, I really think it's going to pass, so I should just buy right now. I don't care what you think. I don't care what I think. Why would I care what somebody else? And no, that's not what trading is about, what I think. The more I think, the less I act. So in terms of, it's not about what, I think support is going to form. I should risk my money based on a hypothetical occurrence happening. That's not what we do. I don't want support to form. My heart, oh man, I really hope more. No, your wants, your wishes, and everything in the market does not matter. The market doesn't care. The market's not a collective conscious thought. It's not how it works. It's the collective conscious thought of a billion people. And so the market will define it. We have to see it first with our visual identification. And so as demand picks up, it thus creates the floor. And that's where you're looking to start making decisions, is not as it's coming down, 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 down. Oh, no. That's not what we look at. When it's coming down, 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 we're just getting excited. We're just getting excited for a hypothetical opportunity. A hypothetical opportunity. But we got to see that build. We got to see support come in. And then we got to see that go up in price and thus confirm that level as a support level. And so that's what support is. Now, I'm not going to teach candlestick analysis, but I want you to kind of see the visual of how this happens on a daily perspective, a weekly perspective, or quite frankly, whatever time frame you're personally looking at. And so when it comes to the market's coming down, down, down. Now, as you can see the market down, 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 you see these are what is called candlestick analysis. Now, guys that tackle trading, and this is for the non-pros out there, okay? For those of you who are finding us for the first time, a couple things I want you to look at. For you pro members, you can get access to the Technical Analysis 101. Tech 101 will help you understand a little bit about candlestick analysis, a little bit about price action in general. In the STEP system, which yes, we are running a special on the STEP system right now. That's why I'm doing this webinar. But well, that I like to teach. But we're running a special on that right now. And so in the STEP system, yeah, we detail, I believe, about an hour of candlestick analysis, detailing all the different candles, the different candlestick patterns and all that. But for right now, especially for you new traders, for right now, I just want you to think about candlestick analysis from a momentum perspective. Finish this statement for me, ladies and gentlemen. Things in motion have a tendency to what? Stay in motion, right? And who said that? Who gets the apple today? Who said that? Things in motion have a tendency to stay in motion until an object appears that stops the motion. Now, that was old Sir Isaac Newton. And Isaac Newton said things in motion have a tendency to stay in motion. Well, from a candlestick perspective, from a trend perspective, from a pattern perspective, momentum is certainly real. And so when you're looking at it from a momentum perspective, big red candle, it opens here, sell, 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 sell. Since everybody and their dog is selling, we're seeing the distribution in front of our very eyes. Hedge funds are selling, Ma and Pa is selling, my doctor and my dentist are selling, and who's buying? I don't know. Don't care. That's not my concern. I'm not going to call them up. I'm not going to interview them. I'm not going to look at their portfolio of what they're doing. It doesn't matter. It just doesn't matter. Because our trading is done with ourselves. The opposite end of every transaction is just the marketplace. When I want to buy something, I buy it from the market. When I want to sell something, I sell it to the market. And so from a momentum perspective, we call these big red candles, big red. Big red has momentum. Momentum is a powerful concept in trading. Momentum, like Isaac Newton said, has a tendency to stay in motion until an object appears that stops the motion. And that object is a very important object when it comes to the identification of support. When you're looking at the downward movement in price here, ladies and gentlemen, and again, we're kind of like microanalyzing this to a certain extent. When you're looking at that distribution that creates the lower low, what will happen at the very top of it, you'll start to see big red candles. Big red candles drive down, drive down, drive down, because think again what creates the big red candle. It's not something that is unique to us individuals. Remember, underneath support, you have stop losses. Traders are trained to take action. And so what happens is you simply see orders come into the market, sell, 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 and that drives the market down, 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 down. It's in motion. The bears have momentum. Momentum has a tendency to continue until it doesn't. Now, the object that we're waiting on is for the momentum of the candles to shift, to start creating that U shape, to start creating that V shape. You have to see momentum shift. So before the bulls have momentum, the bears have to give the momentum up. And so for the bulls to acquire, they have to acquire from the bears because everything is based on equality here. And so as the bears have momentum, they have momentum, they have momentum. Oh, what is starting to happen as the market is going lower, 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 lower? It gets oversold. Traders aren't going to chase. They're going to lock in profit. And to lock in profit, they have to close the trade. They have to take the opposite side. And all of a sudden that shifts the momentum. Now, big candles like bullish engulfing, piercing lines, dark cloud covers, bearish engulfing, these big candlestick patterns, they have a lot of momentum behind them. There's a class of candlestick analysis called the doji. A doji is what is known as a narrow body candle, is what it is. It's a very small candle relative to the candle surrounding it. Now, what the doji represents is basically indecision. It's net neutrality. Buyers and sellers. It's trench warfare in World War I. Nobody wins. It's buyers and sellers on equality. Somebody's buying, somebody's selling. Somebody's selling, somebody's buying. That type of scenario. But the indication it gives us as traders based on the preceding price movement is extremely important. If you just look at a doji, it tells you absolutely nothing of any significance. Nothing. It literally means nothing. The definition is indecision. The definition is literally nothingness. But momentum is something we attack or believe in. And from a momentum perspective, before the bulls acquire it, they first have to eliminate the bearish momentum. And so as the momentum is going down, 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 bears have momentum, probability is down. The visual identification is those narrow candles that come in at the lower price thresholds, and you can start to see it. Look at the visual, drive down, drive down, drive down. It starts to cease a little bit. The candles start to get a little narrower. The candles start to get a little narrower. The candles start to show a little bit of shifting dynamic. The candles now have momentum. And so when you're looking at candlestick analysis, and again, candlestick analysis can be an extremely detailed subject matter, but at the end of the day, guys, and I've studied a lot of candlestick analysis. In fact, I've sat down with the author of candlestick analysis many years ago. And I simply believe they try to make things a little bit more complicated than they need to be because it's very difficult to sell a 2-paragraph book. I truly do believe that, guys. I truly do believe what you can teach in trading, like you could do it in 2 pages. Big body candles, narrow body candles. All candlestick analysis is about momentum. Everything else is just a name. That name has to be detailed and described. That creates a 400-page book. That creates a lot of confusion. But at the end of the day, it doesn't matter what the name is. No. Doesn't matter what I call it up here. No. What matters? Doesn't matter how I feel about it. No. Does anybody care about my opinion? No. What I care about is momentum. That's what I care about. And so who has it? Buyers or sellers, bears or bulls, supply and demand, accumulation, distribution, many different names for it. But who has it is who I want to attach myself to. And so when you're looking at the bears sell, 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 what are we going to start seeing at the low price to indicate that those buyers are coming back in? Well, what we're going to see is those shifting characteristics of the candlesticks. You're going to see the slowing momentum. The candles were big, now they're smaller, 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 till the point you get to that doji where it's basically nothingness. But because the bears had momentum, driving price down, and now no longer do they have momentum, we like to see that as a bullish catalyst because you see the bears slowing their momentum. We see that as an opportunity to come in as accumulation is happening. The distribution side of the equation is now over. The accumulation side is happening. We want to attach ourselves to that. So pro tip, everybody, tackle trading. You already know this. This is for everybody else. Pro tip, big candles have momentum behind them. Momentum has a tendency to continue in the direction of the preceding momentum. Big red candles have a tendency to beget big red candles. but there is that object that appears that stops the motion. And that object is that small candle. Now, again, does it matter if it's a morning star or an evening star or a doji class or a bullish harami or a bearish harami? No, it doesn't matter. Those are just names. That's all it is. What it matters is the visual identification. Shifting momentum. Now, once again, shifting momentum is not a bullish thesis. It's a lack of a bearish one. It's not a bullish one. Again, it's the identification of the shifting momentum that prepares you to take action. But once again, as always, guys, just because we have a low range candle on a random Wednesday does not mean you have a trade. You have to couple that with your trend, your pattern, and then ultimately you have to see that upward movement in price. Or at a bare minimum, you have to learn how to identify an order to get into the trade based on certain set parameters that only get you in upon what is known as confirmation. Now on the downside, guys, resistance works the same way. Bullish up, bear down, doesn't matter. Resistance is above the price. Support is always below the price. Resistance is always above the price. Support is designed to stop the stock from going lower. Resistance is designed to stop the stock from going higher. Resistance drives the market back down. Now, if I had a balloon in my hand right now and I let it go, it would just go to the ceiling. That's resistance. That's resistance. It's a known catalyst. I can see it. It's right there. I got to turn on my light, by the way, but I don't want to. So you're just got to deal with me like I'm behind some screen and I'm getting interviewed. We'll get that figured out sooner than later. But the reality is, guys, resistance is always above the stock, and it's designed to drive the stock down. The market works very similar. As the market is going up, 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 accumulation is happening. Traders start to lock in profit. As traders start to lock in profit, thus, i.e. equal distribution, that drives the market back down. Now, candlestick analysis. Once again, detailed subject matter. Check out Tech 101 in the STEP system at Tackle Trading for it. But candlestick analysis, you see a very similar thing. Does it matter what this is called? Does it matter what that big green candle's called? Or does it only matter that it's big and green and we understand the momentum behind it? We don't know what created the momentum. This is just a thing I drew on a chart somewhere. That's what created the momentum. I did. But we don't know all the buyers, all the philosophical, political, economic viewpoints and psychological personality of every trader that has ever done a thing. We don't care. We don't care. What we care about is momentum. That's what we care about. And so as momentum picks up, bull, 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 what are we going to start to see to show this shifting momentum? You're going to start to see narrow candles come in, those slowing momentum candles. Again, the visual identification of it. Don't care what I think, don't care what I feel, I care what I see. That small candle tells me something. It tells me after the big, strong move of 4 straight days up and up and up and up and up, where seemingly it felt like it was going to go up forever. Well, no, now it's not. I got to respond to that. And how do I respond to it? Well, if the market is distributing, I'm going to do the same thing. If the market is locking in profit, no, I'm going to do the same thing. I'm not going to hold in the face of that. I made my money. I hit my double. I'm going to go live to fight in another stock. I'm going to go, while this one takes another week and a half to establish itself in a high base or a retracement, there's 1,000,005 other stocks out there. Or like my buddy Coach Tyler says, Matt, there's a quadrillion, billion, trillion different opportunities every day in the marketplace. I don't have to chase this. I don't have to chase what XYZ stock it is. Show a little patience. allow it to establish better technical parameters. Now, from a momentum perspective, you're looking at big green candles equal momentum. As the candles get narrower, what is starting to occur? Well, what is starting to occur as the candles get narrower is you're starting to see the visual identification of supply. You're starting to see the visual identification of distribution. That's what you're visually identifying. It's real. It's not a hypothetical. The only question is, what are you going to do about it? Now, that's how you identify support forming, is you identify the shifting characteristics of the candlestick analysis within the overall trend. And so once again, when you're looking at the three major concepts when it comes to the art of swing trading, you first you take into account the trend. The second thing you take into account is the pattern. The third thing you take into account is the identification of support and resistance. Today, so far, you've learned how to identify trend analysis based on the 1, 2, 3 core pattern within a trend analysis, what creates the trend, the psychological behavioral factors of why traders do certain things within the trend. Now let's talk about the catalyst that create the support and resistance. So when it comes to support and resistance, once again, do I identify support or resistance, or does the market identify support or resistance? Trick question, Team Tackle. Is it me? Is it you? Is it Coach Tim? Is it Coach M? Is it the Queen? Well, it is the Queen. Yes, the answer is yes to that one. Queen, I'm doing Queen's Court tomorrow. The answer was yes, yes, yes to the Queen. But for most people outside of the Queen, guys, we don't put in support. We identify support. But we have to learn how to be prepared for when these shifting momentums occur. Now, this is what we call a technical catalyst of support and resistance. Technical catalyst of support or resistance are areas on the chart, they're techniques we utilize on the chart to identify where support and resistance could form. They may or may not, guys. Simple reality. They may or may not. We got to be able to see it happen. So these are levels of where it hypothetically could form. Once again, you still need to see that supply come in. You still need to see that demand come in from a support or supply from a resistance. There are 5 major catalysts that act as support and resistance. Some are more popular than others. First and foremost, you have what is known as significant price thresholds. These are what's known as significant whole numbers. You'll see it happen a lot in the market, guys. $10. $10 has a tendency to act as support and resistance a heck of a lot more than $11 does. What's the difference? Psychological. Has nothing to do with anything besides psychological behavioral factors. How you and I behave over certain numbers that have anything to do with money, because of our relationship to money, we have a tendency to behave differently around those price thresholds. We behave differently around $10 than we do 11. Simple reality. How do I know that? Because support and resistance manifests itself at $10 far more than $11. It happens at $20. It happens at $50. It happens at $100. It happens at increments of our currency. And it happens internationally as well, guys. Same thing. When I was in Taiwan teaching, same thing. Or excuse me, not Taiwan, Thailand. When I was in Thailand, same thing, just different numbers. When I was in, when Coach Tim was in Malaysia, same thing. When I was in the Philippines, Hong Kong, same thing, just different numbers. It's how they're psychologically programmed around their currency numbers, because currency is so vitally important to us, how our psychological nature and behavior around currency happens. These thresholds from a significant whole number perspective simply take on a greater importance to traders than 11, 12, 13, 14 does. The second level, the second way you can identify support and resistance, known as a catalyst, would be previous areas of support and resistance. The third way, trend lines. The fourth way, moving averages. Moving averages are so vitally important today. In fact, I'll say this. They are more important today than at any point in human history, moving averages today. And the reason, it's very simply algorithms. It's the easiest algorithm to program is a moving average crossover system, or a moving average momentum system, or a moving average support bounce system. It's the easiest thing to program. It's 2+2 type stuff. So moving averages, and once again, popular moving averages, 20, 50, 200 SMAs, 9, 13 EMAs. If you like a 48-day crossover, but nobody else does, you're not unique. You're not a snowflake. You're just doing it wrong. Technical analysis works not because you found something unique to you, because you're the unicorn. You found it unique to millions of other people as well. They might just call it something differently. Last, but certainly not least, one of my favorite zones is what is known as Fibonacci retracement levels. So technical catalyst can be areas on the chart where we expect support to form. So once again, when it comes to putting this all together, I didn't want to kill my PowerPoint there. So when it comes to putting this all together, guys, when it comes to a trend, once again, have you guys had fun tonight? Have you guys enjoyed yourself tonight? Have you learned a lot tonight? I really, truly do hope you have. So when it comes to the art of a trend, we're going to try to put this all together very quickly. Now, in a bullish uptrend, once again, ladies and gentlemen, get those fingers on the keyboard, answer the question. You're here to learn. Learning is not passive, it is active. Get those hands on the keyboard, answer questions, participate, ask questions. Now, in terms of a trend starts with what? Based on what you learned here tonight. By the way, we're going a rock solid hour and 40 right now. Well, hour and 40. Yeah, about an hour and 40. Are we an hour and 40, Tim? Fantastic. What does it start with, ladies and gents? Starts with a breakout. That's right. Starts with a breakout. So we start with some degree of neutrality. Some degree of neutrality. No pivot confirmation. Some degree of neutrality. I got to draw that one better. I was trying to draw random volatility, but I didn't like it. So give me a second. We're going to do that a little bit more consistent here. All right. We'll draw it clean. I'll make Christian happy. There we go. We got a clean chart. Ooh, you know what I like to? Front running. That. Now, we got a clean chart of neutrality. What does it start with? Starts with breakout, right? Starts with breakout. Pattern number one, breakout. Breakout has to break out of the previous level of resistance. And so what we traders do, ladies and gentlemen, I'm not going to get into the specific 10% of the ATR above this or 25% of the ATR of this. We're here to teach an introductory training for everybody out there. So in general, what we like to do is we like to place an order above resistance because, again, let me ask you guys a question. Very simple. Do we know when the stock's going to break out? Do I know the day? Do I know Microsoft is going to break out next Thursday? If it does, fantastic. That's awesome. But it's random. I have zero clue, right? What I do know is that this stock has resistance at $34. That's what I know based on this example here. So do I know if it's going to break out then or then or then? No. Now, I certainly can just wait, guys. And this is why I teach you in the STEP system is how to analyze this, how to analyze where do I want to put that order? Do I want to be aggressive and get it above resistance? Do I want to wait for confirmation? These are subjective things in analysis you have to learn how to make decisions on. And the only way to learn how to make those decisions is by doing it and analyzing it in the moment. Doing it 1,000 times. You'll figure out who you are real quick. But I like to be aggressive on breakouts. because breakouts can explode. Breakouts are what is known as momentum-based patterns. The reason they are known as momentum-based patterns, ladies and gentlemen, is who has momentum upon the technical signal. Now, once again, the technical signal is it has to break out. So if it has to break out, who has momentum? Bulls or bears? It's the bulls. Bulls have momentum. They created a higher level of support here at 32. They have momentum driving the price into the breakout. Price is already appreciating. Bulls have momentum. I like being aggressive there. I like getting an order above resistance to trigger in upon the breakout. That is a momentum-based pattern. The breakout occurs. We like it. We get into the trade. Now, we know the market's not going to go up forever, guys. We know the second pattern is going to form. Now, in the step system, you will learn how to target. You will. Tonight, we're doing basic stuff. Now, in terms of that target, though, we call that pattern number 2. Now, in pattern number 2, we call this the overextended scenario. What do traders start doing? They don't chase. Traders don't chase. Not at all. Traders going to be patient. They're going to wait. If they miss the breakout, they're just going to wait for the retracement. It's going to occur. It might not occur in your specific time frame, but it's going to occur. So what traders do is they're not going to chase. They drilled that setup on the breakout. That's the mindset of the swing trader. That's swing trading 101, guys. Get that order above the breakout channel and let that puppy fly. Well, as it gets into pattern number 2, once again, the overextended scenario, the traders start locking in profit. They start increasing the supply. They start the distribution phase of the Wyckoff cycle, and that drives the market back down into pattern number 3. And in pattern number 3, we call that the bullish retracement. Now, what technique for you new traders did I teach you tonight from a candlestick perspective to help you identify what or where this support level is forming? So for example, as the market's coming down, 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 could support form here? Yes, absolutely support could form there. It could form there, it could drive back up, it could come down, it could go there, and that could give us a beautiful, nice little high base breakout. Sexy, beautiful. Love high base breakouts. Love them, love them, love them. One of my favorite patterns, simple consolidation at the top end of the chart, keep it clean against resistance and breakout. Love that pattern. Just a picture perfect pattern. It's not even distribution. Traders are so stinking greedy. They don't even they don't even lock in profit. They don't distribute anything. They basically say, yeah, I'll just carry. This thing's going to fly. I'll just carry. That's the high base. A lot of confidence in that high base. It certainly could form a high base. No doubt about that. So could support form there? Absolutely. Could support come down further? Form a nice little flag base pattern? Absolutely. 100%. The only difference between a high base and a traditional flag, in my opinion, is whether it goes 21 or 38% retracement. Very similar analysis. Very similar analysis, in my opinion. Could it get something deeper, coming all the way back down to the breakout channel? Absolutely. 100%. 100%. And ladies and gentlemen, I'd love to sit up here and tell you guys, like, yeah, we know it's going to stop at 38. We don't. We don't. We have to identify it. We have to identify it in the moment because we don't know. Remember, I don't know anything and I don't care about anything. Not as a trader. I identify everything. And so where that support level could form during the distribution phase depends. It just does. And it depends on the visual identification of what technique did I teach you. What helps us understand momentum from a singular perspective? Because there's momentum in trends, there's momentum in patterns, but what is one single data point that will tell me that momentum is shifting and thus support is building? It's not when the sell happens. Oh, no. We need to see that support level come in with the shifting momentum of the candle. That's what we want to see. And once we see that momentum shift, that's not when we pull the trigger, guys. We wait for that upward movement in price, and then the buyers explode. We don't need all the evidence in the world. We just need support in a nice uptrend with a slowing momentum candle. And that is all that we need until it is go time. And you know what? There's a lot of news every day. A lot of news. There's political news. There's economic news, central bank news, financial news, a lot of news. It gets really overwhelming at times, especially lately. I'll be the first to admit, guys, I eat, sleep, and breathe this stuff, literally. I spend about 2 hours every morning just getting prepared for the halftime report to make sure that you guys are getting proper news. Totally. I understand it can be very, very overwhelming, extremely overwhelming. But as a technician, I don't care what the news is. You know what? From a political perspective, ladies and gentlemen, we're going to be debating debt ceilings. We're going to be debating inflation, dollars and currencies, and infrastructure bills. All of this. Oh, it's overwhelming. Just wait till you start figuring out geopolitical Chinese stuff. Oh man, today sucked. Lots of news. Tremendous amount of news. As a technician, I don't care about any of it. I've seen enough slowing momentum candles on things that you think the market should be taking on in my career. It doesn't matter to me. The only thing I care about is the visual identification. Let everybody else talk. Let everybody else react. We see. We visually identify trends, patterns, support, and resistance. And so whether that stops here, here, or here, by the way, it doesn't matter. It's just a detail of the deeper retracement. You wait to see support come in. Once support comes in, we are ready to fly. Now, same thing happens on the bearish standpoint, guys. Nice little neutrality coming back in. Let's reset that trigger. Ooh, I love front running. I'm going to do a webinar on front running, Tim. Remind me to write that down. I love this technique in front running. Neutrality, lower level of resistance, going against the breakdown. That's a sexy pattern, but it's not a bearish downtrend until support is violated. Not even in this lower level of resistance against the backdrop is it a trend yet. Only when support is violated is it actually a trend. Once support is violated, we are just simply walking down the stairs until we find support. And that is all what swing trading is about, guys. It's about identifying the visual identifications on the chart, learning the techniques from a behavioral analysis to answer the why support builds, the why resistance builds, the why we see such consistency in technical analysis. But at the end of the day, as a technician, here's what I believe above all things. Everything that is known out there, all the behavioral analysis, all the fundamental analysis, all the political analysis, all the economic analysis, everything the central bank has said will say forever. They never say anything new. It's all embedded in the price. If you can master the art of technical understanding, if you can master the art of reading a chart, truly understanding why price action behaves the way it does, you are going to be a trader for the rest of your life. Period. End of sentence. Whether you're hanging out with us at Tackle Trading or not. If you simply take some time to master these concepts, these basic concepts I went through here tonight, you will be a fundamentally better trader in the future. And I truly do hope, guys, that you had fun tonight. I truly do hope that you got something out of that tonight. And I thank everybody from the bottom of my heart for coming here tonight and spending your time with us. We know you have tremendous amount of other options out there to learn, to connect. And I'm just very grateful that you guys found us at Tackle Trading. I'm very grateful that you guys are part of our community, whether that's pro or whether that's on YouTube. You guys are the best. Team Tackle for life. Thank you so much for being a part of this webinar here tonight, guys. Truly, truly, truly hope you enjoyed it and learned something from the bottom of my heart. Now, with that said, let's talk just briefly about the STEP system, if I can get my PowerPoint to work. And here it is. Guys, everything you learned here today, the basic introductions of everything we went through, was based on a technical system of trading, based on technical analysis called the STEP system. The STEP system is it stands for stop loss, target entry, and position size. It's basically the things we need to get it before we make any trade in the marketplace. The STEP system is our swing trading system at Tackle Trading. It's the system that we apply the scouting reports. So for those pro members out there, guys, our scouting reports, they're all based on STEP system mechanics. And I do think there is power in understanding the system behind the watch list. And so if you do want to learn the STEP system, if this is something you want to be that you do want to be a part of, and you see some value here tonight, and you think you can get even more value with this, I promise you, ask any pro member you can. We love to over deliver. There is no doubt about that. You can get the STEP system simply, guys, very quickly. There's 18 training models, 6 different sessions, 3 modules a session. There's 18 total modules. You get the STEP system playbook. You also get the STEP system guide. Every single month, guys, we're going to be doing a mastermind group. And yes, I have taken a break from the STEP system mastermind groups, but guess what, STEP system guys, STEP system gals, each and everybody, I'm going to come back. I'm going to be doing the STEP system masterminds from here on out. And I am so excited to get in there and doctor this stuff up on a monthly basis with you guys, to theory craft different technical setups, back test different technical setups, case study those scouting reports. We're going to create a true mastermind group, guys. Every single month we meet, I'm going to be there with you every single month as we detail these technical systems. Because, guys, you create a system from a technical perspective. Guess what? You need to talk about it. You need to update it. You need to talk about what works on a monthly basis, how to apply it. Are we waiting for confirmation or not? Are we front running or not? Let's go. That type of scenarios. We're going to be doing that in the mastermind groups as well. And you also get access to our trading journals. And guys, here for the next, I believe, a week. I'm not 100% sure on that. Tim, please clarify if it's a week or 2 weeks. I don't know, but we are giving a discount on the STEP system, $747, retail value $14.97. Guys, you can get there. You can simply go, and Tim, if you will, put the link there in the chat. You can also go to bit.ly/get-step, and you can get access to the STEP system there as well. But guys, truthfully, there is more value in the STEP system than that. I built it. I'm the author. I'm the system designer of it. I'm going to be with you in those mastermind groups. But the simple reality, guys, is if you need to test the waters out, we're good with that. If you need to test Tackle out, if you need to, get a nice little trial of a pro member, see the STEP system, get into, let us know. Email team at Tackle Trading. Coach Mark will take care of you. But guys, you can also test out Tackle Trading Pro membership by going to tackletrading.com, hit the store, and you can sign up for a 15-day free trial where you get access to our amazing rebranded newsletter. Love that thing this week. It was awesome. We also made some modifications there. So definitely, hopefully pro members love those modifications we made to the newsletter. You can get access to our scouting reports, our stock, our options report we put out every single weekend as well. And guys, we also do about 10 different webinars into our pro community every single week as well. So you can definitely check out a pro membership at Tackle Trading. But if you are ready to rock and roll at the STEP, get in that mastermind with me every single month and start learning how to do this the right way from a technical perspective. This is your opportunity, and I look forward to working with you. Tim? I'm done.
Well, I got to tell you, you did a fantastic job. The energy in the chat was on fire all day long. I know you went a little bit longer than you were planning here tonight, Matt,
Oh
but
my
that's the
goodness,
that's the
everybody
nature
knows
of it, right?
that. Like,
Yeah, that's right.
listen, when I teach, like truly, when I get into teaching, time's a flat circle, my friend.
Yeah. And by the way, I loved a lot of the energy in the chat from a lot of our newer members as well. You guys were on fire tonight. Really
You guys are
enjoyed
amazing.
watching the back and forth there. Here's the bottom line for me, guys. Tackle trading can give you so much. Just check in and be a part of it. The STEP system will give you what you need from a rule perspective, a design perspective, system perspective, especially on the directional trading angle, Matt. I saw one question earlier I wanted to throw at you. I think it would be appropriate right now. If you're a cash flow trader, what role should directional trading play in your portfolio design?
I
Because
love this question. Continue. I'm sorry, continue.
well, basically the trader was saying, I'm doing well with Boomerang. I'm doing well with cash flow. I'm in the labs with Mark and Tyler and Emily, and I'm feeling comfortable with those systems, but I know I want to juice my returns. I know I want to find the directional stuff.
Do you know who asked the question?
Man, it was about an hour ago. It was a good chat about it. So no, I don't remember, but
regardless of who asked, I love that question. I know exactly what they're talking about. When you're a cash flow option trader, the rules that you apply are so consistent and so important. Your delta rules and your time-based rules. So when you deal with the options market, whether you're a directional trader or a theta trader, it really doesn't matter. Rules are very important for you. And so, for example, if I'm doing just a covered call and I'm writing a covered call against a long-term investment, the delta I sell is going to be based on my technical analysis read of the market. And so if I'm using, and I use my STEP system techniques a lot in cash flow systems as well, because it allows you to maximize your ATR ranges against the options you're selling, making sure that you're applying your technical skill set and your momentum behind that. And so what I have found by combining your technical skill set with your zones, right? Your cash flow systems, right? I've found that if you apply the things that I do teach from a technical perspective, you can make sure that your cash flow systems are that much more effective and that's much more efficient, because what you can do is you can maximize certain deltas you're selling. For example, if all I'm doing is lobbing grenades called cash flow condors and I don't even care, I'm going to lob a 5 to 10 delta contract and we're going to be just fine, right? I mean, you basically say, I'll take the probability all day long. But if you wait for, say, a bearish breakdown and you're applying technique number one and it's violating support and you wait for your timing, you could actually be a little bit more aggressive on the deltas that you are selling and thus bring in a tremendous amount of more cash flow than you otherwise would have if you sold a very, very, very low delta contract. And so I feel like you can be a little bit more aggressive with the deltas that you do sell and still maintain a certain degree of confidence, very similar to what the confidence level you would have selling a lower delta. But because you are now applying your technical skill set that you've learned in the STEP system, you're maximizing your ATR ranges and efficiency.
100%. I love the answer there. A couple of little bits of feedback coming in as well. Linda says the STEP system is so great, very educational, best course I've ever taken. I have 2 BAs from UCLA. STEP system is the best course ever. Linda, we love you as always, and I appreciate that.
Yeah, Linda, I love you too.
Yeah. She must have won in fantasy football this weekend.
Yeah, she doesn't count. She's my student. She's like
she counts the whole way.
Linda is my hey, I don't say this to everybody. No. Linda is one of my favorite people of all time. One of my favorite people of all time. I met Linda a few years ago now, and I had the fortunate opportunity to actually become her mentor. And man, the personal relationships you have with people as a mentor are unique and special. And Linda, thank you. I really do appreciate that. But again, you're biased, so that doesn't count.
Well, no, it does.
And you're going to whoop my butt in fantasy this year, so that doesn't count either.
The whole way. By the way, Sandeep also saying STEP system is an absolute must. Great show as always, Coach Matt. Thank you very much.
Thank you, Sandeep.
That's wonderful to hear. A bunch of people saying great job. I don't need to feed your ego too much more on a Monday.
Oh, come on. Like
I got about 100. Great job. You're a great teacher.
You guys don't know what I've went through today. I had 2 computers completely crash on me. My PowerPoint died on me. 25 times, guys, 25 times. All my stuff was saved. It's gone. I literally, the reason I whiteboarded everything so much tonight is because I literally did not have technology. Like I am doing, like, I'll take the compliments.
All right, then I'll give you a couple of them.
Usually I'm like, oh, you guys are fine. You guys are fine. But no, I had I built a laptop to put this webinar on. Actually, I didn't. My son did, but
He did come down to help
we
you.
did work out.
Yeah. Well, I'll make it simple. I'll give you feedback from me. That was an excellent 2 hours of education. Anybody who attended it probably got a lot out of it. We have a lot of likes on the channel here from this tonight. Obviously, people were engaged and very, very happy with it, Maddie. So great job tonight. I got to tell you, really, really great job.
Well, again, I appreciate all of you guys, and you'll see me again. I'll be tomorrow on the halftime report.
That's right. And I do want to address one thing I saw in the chat here tonight in a positive way. A lot of great questions out of some of our newer members from Team Tackle. And I want to sum it up, Maddie. A lot of people who probably have not been through some kind of formalized system training or education, they really don't have the rules designed perfectly yet. And there was a lot of great educational questions. Where do I take profit? How do I deal with T2? What do I deal with this and that? And I got to tell if you're,
I was supposed to teach everything?
No. I got to tell them this is why you need the course. It's really that simple. This is why you need the course. You need structure. You need education. You need to become a part of a community where coaches with answers to those questions can help you with them on a day-by-day basis as you're building your skill sets.
Honestly, Tim, I made a conscious decision to keep it high level and keep it basic tonight. And I wanted to do that. This was not supposed to be designed as a advanced course. That's what the S.T.E.P system is. That's what we do in our pro member community. That's what we do in coaching. That's what we do in all of those programs. I wanted to keep it basic. I wanted to keep it so people can understand, especially for beginners out there. I take great responsibility in making sure that beginners do not get overwhelmed at first. I get it. Everybody wants to get into Elliott wave and Fibonacci, but you have to understand that takes time. It just does. And I would like to sit down and teach everybody how to target Fibonacci extension based on wave theory. But the reality is that we're not there yet. That's not what the design of this was.
Well, that's where the mastermind groups come in, right?
We're going to theory craft all day long.
Yeah. And those never, that's the whole thing, is that literally on a month-by-month basis, we continue to adapt, we continue to evolve, we continue to stay committed to education. I loved it tonight. People probably need dinner and to watch the end of the NFL game if they are a football fan. So we are going to wrap here on a Monday. Wonderful job, Matt. Appreciate you as always. I have dropped the link to the S.T.E.P system course inside the chat in YouTube. I've also put, quite a bit of comments in there answering people's questions. Guys, just come join us at Tackle Trading. There's all the information you need about tackle trading in the description of this video just below you. You can join us, become a pro, and get that S.T.E.P system. All right, guys, we're out for tonight. We'll see you tomorrow on the halftime report.
Oh, one quick thing,
Tim.
Thing, yeah. Very, very quickly. Again, we will cover a lot of those techniques that they were asking regarding, hey, what do we do at target one, target two, and all that? A lot of that's mastermind groups, guys, but we also have trading labs on a weekly basis that you can get with Coach Tyler, Coach Mark, Coach Emily, and they are all very, very, very familiar with the S.T.E.P system. All of them were part of the creation process. You can ask them questions the same way you ask me in the masterminds. You can get them in the labs as well. Or Traders Lounge tomorrow. Guys, we, again, do about 10 to 15 webinars every single week for our pro members. We have lots of conversations every single day with our pro members. This is just one conversation that we're hoping to have many with you over time.
That's exactly right. Wonderful job again, as always, Matt. We're done for tonight here, Team Tackle. We will see you tomorrow in Tackle Trading.